Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends.
Welcome, everyone. Thanks for joining us today. And starting out, selling into new states is obviously something that we're all familiar with today. I mean, it's the level of e-commerce is such that it's just sort of second nature to think that we're not in any way encumbered by the borders anymore. Now, I think what's important to note, and this is something that is now fairly I think knowledge base has sort of grasped it, but there's kind of two levels of sort of requirements that exist throughout the country today in regards to doing business across state lines. And what we're really talking about is nexus. Nexus is just the term we use to define whether or not a company is subject to the laws and requirements of a specific state or jurisdiction. If you don't have nexus in a jurisdiction or in a state, you don't have an obligation to comply with their sales and use tax laws. And the primary sort of definition of nexus has historically been a physical presence. And so the standard was, do I have an office in the state? Do I have inventory in the state? Do I have employees? Do I have sales reps in the state? Whether or not those sales reps are permanent or whether or not they're traveling temporarily or periodically throughout the state. Those are all examples, frankly, of physical presence. So once you've triggered physical presence in a state, it is time to start asking the question, do I have an obligation to comply with the sales and use tax laws? The real sort of development that's been very impactful to our economy from a sales tax perspective over the last 5 years is the economic standard. And this has come about as a result of the Wayfair decision. This was sort of it was a Supreme Court decision that was involving the state of South Dakota, which had enacted an economic nexus standard and had asserted nexus on Wayfair, Wayfair being an online home goods store, and essentially said, Wayfair, you have exceeded $100,000 in revenue in our state during the past 12 months or past calendar year. And as such, we believe you are obligated to comply with our sales and use tax laws. Interestingly, Wayfair fought this assertion. It went up through the Supreme Court of the state of South Dakota, and the Supreme Court of South Dakota actually ruled in favor of Wayfair. And so the state then took it up with the U.S. Supreme Court, and in June of 2018, the U.S. Supreme Court ruled 5-4 in favor of an economic nexus standard. So they basically deemed this new law in South Dakota to be constitutional, and as a result, and as you might imagine, all of the other states sort of bought in. They all established their own legislation relative to an economic nexus standard. And it started, like I said, in 2018, and the more recent, or the last state that was kind of holding out was Missouri. Their economic standard or their laws went into effect January 1 of this year. So in every state now, to the extent you exceed $100,000 in revenue during a calendar year or during the past 12 months, you should be asking yourself the question, have I triggered nexus for sales tax purposes? Now, that being said, there are states that are a little bit different. California, Texas, they have a $500,000 threshold rather than a $100,000 threshold. Mississippi, Alabama, I believe those are $250,000. New York, I think, has a $500,000. But the majority of the states, other than those, have a $100,000 threshold. There's also an element of transaction volume. Probably half or more of the states, in addition to the economic nexus threshold on revenue, also have an economic threshold on transactions. In essence, if you have more than 200 transactions in a 12-month period, regardless of whether you exceeded $100,000, that would give you nexus in the state and require you to comply with the sales and use tax laws. My perspective on all of this is that I encourage companies to simply evaluate their revenues periodically, maybe every quarter, maybe every 6 months, maybe annually. And to the extent that those revenues are in excess of $100,000 in a given state, ask the question or confirm whether or not nexus exists. This is sort of the first step for any discussion we have in the sales and use tax arena. Without nexus, you don't have an obligation. But just by having nexus doesn't mean you have an obligation. You can have nexus and not have any transactions or revenues that are subject to sales or use tax. There are other elements to this equation. But again, the first step, do we have nexus? If yes, now let's evaluate our taxability. So what poses the biggest challenge to managing your sales tax obligation? Bandwidth and expertise doesn't surprise us. What's interesting about that leading the pack is it coincides or parallels the fact that the overwhelming majority of companies in the United States are really trying to manage sales tax internally in its entirety. I didn't go into really any kind of dialogue about TaxConnex, just to kind of give you some perspective as to how we fit into this whole world of sales and use tax. Our business model is designed to focus on small to mid-sized companies. The idea is those companies don't have the infrastructure, the wherewithal, the bandwidth and expertise to manage sales tax compliance in-house in a lot of ways. So our primary business is the outsourcing of the compliance process, meaning we're handling the filings, the remittances, the correspondence. We have about 350 clients throughout the country and internationally. And in addition to all of our compliance work and outsourcing work, we also do a good bit of consulting. And my role actually in the business is to lead our consulting activities. And we'll do consulting work for companies that are in need of a compliance outsourcing relationship long term, or maybe they're not in need of an outsourcing relationship long term. So a lot of times we'll come into a scenario that the client doesn't really understand their nexus footprint yet. We'll analyze that nexus footprint, determine whether or not there is a need to evaluate the taxability of their products. And that's sort of the next step. So once we say, yes, we have nexus, the next question is, do we have a taxable product or a service that we need to address? And nexus, as I described earlier, there's a variety of sort of variables and thresholds that might exist from state to state. This is more so true in the taxability side, meaning there's a whole host of unique tax laws and unique tax positions that the states have taken. Generally speaking, all of the statutes in all of the states that do have a sales tax start by saying the retail sale of tangible personal property is subject to sales tax. So that's true in all the states. There are 5 states that do not have a state level sales tax, those being Alaska, Delaware, Oregon, Montana, and New Hampshire. What is interesting about Alaska is while they don't have a state level sales tax, they do have what we call home rule or city level sales taxes. These are sales taxes that are administered at the city level. And another interesting fact about Alaska is those cities have kind of come together in a coalition to establish their own economic nexus standard. And that is basically the same as a lot of the other states. To the extent you have $100,000 or more in sales into Alaska at the state level, you automatically will establish nexus with those cities and be required to comply in those cities, but only to the extent you have taxable products or services. Now, in addition to tangible personal property, a lot of states tax services. Our entire economy is migrated heavily from tangible personal items and goods to services over the last couple of decades. So as you might imagine, the states are trying to kind of keep up and in some ways make sure their tax bases aren't eroded entirely. So a number of states have and do charge tax or apply tax to services. When we think of the primary services that are taxed, we think of telecommunication services. Almost all of the states are taxing those fairly extensively. There can be taxes applied to utilities, but a lot of times it's services associated with the sale of tangible personal property, installation services, shipping services, things of that nature are commonly taxable in a lot of states. Not every state, but in a lot of them. The other characteristic that exists out there, and this is true with particularly companies that are heavy in the service element of their business, is bundling. Bundling refers to simply taking a number of products, services, SKUs, and sort of packaging them together. Most common would be, in the old days, we would get a free cell phone if we signed up for cell service for a year. That's a bundle. And so there's in any given industry, there's sometimes a desire to bundle some services with tangible personal property, or maybe just bundle different services together, some of which might be taxable, some of which might be exempt. That bundling approach creates a great deal of anxiety. It's taxing, no pun intended, on tax calculation software packages, because a bundle essentially is very custom, and it's very, very specific to an industry or company's products or services. So in general, when you go to leverage a tax calculation solution, you'll probably struggle to map your bundled products and SKUs to the appropriate category. It can be managed. It just has to be managed in a more customized fashion. There has to be some interpretations and general experiential knowledge applied to make that effective. The other thing that's a challenge when you start expanding into multiple states is citusing. Citusing just simply refers to what tax applies. If I'm based here in Atlanta, Georgia, and I'm selling to a customer in Columbus, Ohio, and I ship it FOB destination, is it the Atlanta sales tax that applies on that transaction, or is it the Columbus, Ohio sales tax that applies to that transaction? Generally speaking, the overwhelming majority of transactions that we see here in the United States are FOB destination, meaning they are the responsibility of delivering the product to the doorstep of the customer is on the vendor, and as such, title is deemed to have transferred at the customer's address. So more often than not, that's the way sales tax is cited, and you would then choose the Columbus, Ohio tax rate, and you would have a requirement to file and report that tax to Ohio if you had nexus in Ohio. So those are some of the challenges that are unique, and every state, after tangible personal property, every state is going to be very unique when it comes to services, bundling, and even citusing to some extent. So we talked about expanding into more states. That's a challenge from a nexus perspective. You've got to be aware whether or not you're kind of triggering nexus in those states where you start to expand. Then we talked about the taxability, the variables that exist out there, and when you start to add new products, particularly bundles, there's a good bit of challenge that goes along with that and addressing that on a state-by-state basis. Another avenue that a number of our clients are facing and have challenges with is just the different sales channels, whether it be direct website sales for their own website. Maybe they've been operating in a retail fashion for a long period of time, and they're going to now enter the wholesale market. In other words, they've been selling maybe on a smaller scale, direct to consumer, and now all of a sudden they've got a major retailer that wants to carry their product. Or maybe they've decided to leverage multiple boutique retailers throughout the country. So now we have wholesale transactions. And then finally, there's obviously a lot of us that are engaged in some of the online marketplaces, which we commonly know as Amazon, eBay, Etsy, those kind of companies. So let me just talk through those three primary sales channels. On the e-commerce side, essentially it's almost like you've got a brick and mortar store that's in the cloud. And so the real challenge there is usually situsing. In other words, if you did have a brick and mortar and people were walking into your store and picking up products off the shelf and then checking out at a register, those transactions would all be taxable based on that particular location of that store. So you'd have a single sales tax rate that would apply. Now that sales tax rate may have state, county, city, different components to it, but it would be fairly simplistic. When you get into the e-commerce world, as we've already talked about, you start to get expansion of your footprint in multiple states. You start to expand the taxability or the complexity thereof, and then you start getting into situsing rules. So you've got to be able to address all of that to be able to have a true and effective tax calculation. So the onus is on you to the extent you have your own website is really the way to think about that. When you get into the wholesale market, there's a different kind of complexion that comes into play here. For the most part, what we're dealing with is what we refer to as exemptions. Exemptions are basically scenarios where I'm buying something that's otherwise taxable. So I'm buying a colored pencil, and at the same time, I'm going to buy it to put it in the store. I'm going to put it on the shelves of my store and resell it. So in that particular scenario, I would qualify for an exemption as a customer, and that exemption would be for resale. To achieve that exemption, I have to be able to provide my vendor with some type of documentation substantiating that I have the authority to buy something exempt from tax. And that's where we refer to resale exemption certificates. So those are documentation requirements that would exist. I did highlight exclusions in the presentation today. Exclusions is just another way of saying exemptions, but it does mean something different. Exemptions are transactions that are otherwise taxable, but for the nature of the transaction or the nature of the purchaser. A nonprofit organization, a government agency, a reseller. Exclusions would apply when you're providing a service that is not subject to tax. So in most states, the services we provide here at TaxConnex are excluded from sales tax. So in the state of Georgia, we don't have a requirement to charge sales tax on our services. We're excluded from tax. The final piece to consider, particularly if you're primarily wholesaling, is drop shipments. The world of drop shipments can get somewhat confusing and complex as it relates to sales tax compliance. And the primary complexity here is what rule applies, what state's exemption applies, and how do you document that exemption? What are the options available to both the purchaser and the seller in terms of the documentation requirements? And then we're not going to go into that today. I think we've done another presentation that was entirely on drop shipments. Suffice it to say that if you're engaged in drop shipment transactions, you've probably already encountered a few of those headaches, and you probably could use some help. Maybe some options may exist for you that you don't otherwise realize exist. So drop shipments, particularly in the wholesale arena, are quite a challenge for companies. But again, the intent in the wholesale category is that we don't have a taxable event. We shouldn't need a tax rate. We shouldn't need a tax calculation. We should be able to achieve exempt status or exclusion status for those transactions. And then lastly, marketplace facilitators. One of the things I think that was a big part of the Wayfair decision, the economic nexus standard, was that it also introduced an opportunity to more economically and blanketly apply these rules to marketplace facilitators. A marketplace facilitator for purposes of sales tax is defined as a source, typically a cloud-based store that offers for sale products and services and also accepts payment, processes payment for those products and services. And then essentially includes the logistics of shipping, but sometimes the shipping can be done by a third party. So Amazon, eBay, Etsy are all good examples of that. And in those examples, those companies are, for the most part, they have nexus in most of the states, if not all of them. They have an obligation to actually charge the tax, collect the tax, and remit the tax to the jurisdiction, even though they may be selling product on behalf of a third party. So if you're selling through Amazon, Amazon should be calculating all the tax that needs to be calculated for you, and you would not have a responsibility there. A number of our clients fit in all three of these categories, and so they're consistently having to sort of monitor their receipts. How do we calculate gross receipts if we're in all three of these categories for purposes of nexus, that $100,000 threshold? That can vary by state. So there's just a number of challenges that as you expand and sell new sales channels that you'll face. If you are trying to manage sales and use tax in-house, it's not typical that you will have a great deal of experience with it, particularly if you're a small or newer business. And what does seem to happen, and what happened, up to the Wayfair decision, was we had a lot of technology businesses that were operating in the cloud. Their customers were receiving the benefit of their services electronically. They didn't have a physical presence, so they didn't have a requirement to register in all the states in which they had customers. But as soon as that Wayfair decision, that economic nexus decision was handed down and legislated in all the states, now all of a sudden, this technology business, which let's just assume, for argument's sake, they were based in California, they now have to understand the tax treatment, taxability for sales tax purposes in all of the states in which they've established nexus, economic nexus. And it so happens that the state of California doesn't really tax digital products and services. So electronically downloaded software is not taxable in California. Software as a service isn't taxable in California. And so a lot of these companies were in for a big surprise when they weren't paying attention to their nexus footprint and all of a sudden found themselves in a myriad of tax implications across multitude of states. And, as a high-tech company, they're looking to sell their business. And then all of a sudden a buyer comes in, does due diligence, and there's a whole world of hurt. And we'll talk about that when we get into the mergers and acquisitions slide. But again, as everybody sort of saw with the first polling question, the challenges relative to having any level of expertise in-house, even if it's not expertise, you've still got to have bandwidth to be able to execute filings, keep up with the tax calendar, keep up with the growth of the business and where registration needs to take place, and then deal with correspondence. The states, once you get registered and you get sort of tagged by these states with an account, you're going to get correspondence. Some of those correspondence are fairly commonplace and of no real consequence. It can simply be thrown away. And then 1 out of every 10 might be a very difficult or challenging or risky notice that needs to be addressed. So so long as you're trying to manage this expertise, this bandwidth and this process internally, you're going to have those levels of risk. And eventually you're going to find yourself in places where the person that was responsible for this, that had just gotten very comfortable doing it, you felt comfortable that all your liabilities and risks were being managed well, all of a sudden they decide to take another job or they decide to retire. And now what do? You've got this big void, and plugging someone into that, we have seen time and time again when that happens, companies, they just miss it. It was a part of that person's job who left. It wasn't their entire responsibility. And so they tried to plug the hole of that job without consideration for the full scope of the work. And you end up with delinquencies on the sales tax side, which leads to arbitrary assessments from states. And then you have notices that are being sent with these arbitrary assessments that have deadlines in which you can have appeal rights. Nobody's paying attention to those notices. And 3-6 months later, you've got a bill due of $100,000. An arbitrary assessment doesn't even have any relativity to your real activity, but because you didn't manage that notice effectively, by statute, your option for appeal is expired. Now you've got to stroke a check. So there's real risk there that can exist. And that's just an example of one element of risk. There's a whole multitude of risks. Are we applying the tax appropriately? Are we citing our transactions appropriately? Do we have the right rates? There's just a whole host of things. Are we collecting and maintaining our exemption certificates? All of those are factors. Components and activities that occur within that sales tax compliance environment are more than most of us realize. They do tend to expand. When you're operating 1, 2, maybe even 3 states, not a big deal. It's something that can be managed. When you start getting into 5, 10 or more states, you start to really you need to make sure you've got a good process. You got to have process controls and oversight to make sure things aren't slipping through the cracks. The last sort of topic we wanted to address today was sort of the end game in terms of where does the rubber meet the road? Where does the risk come to a place where I've got to come out of pocket, or I've got to pay the burden? And it's more common that it happens during mergers and acquisitions, but it also can happen because you're selected for audit. You don't have a lot of control over when or if you're audited. Obviously, you do have some control as to whether you want to go down a path of a merger and acquisition and then be subject to due diligence efforts. But, ultimately, you should always be asking the question, as a company, what are our objectives? Where do we want to be 3 years down the road? And if we are looking to ultimately end at an equity event, a merger or an acquisition, it's a really good idea to consider sales tax in that equation. If you go back 10, 12 years, maybe even longer, there wasn't a whole lot of noise around sales and use tax risk. And it was something that was hit or miss during due diligence. And when we've talked to CPA firms today and over the last 7, 8 years, particularly within the last 5, and we've talked with PE and VC, they all say the same thing. Sales tax is a huge factor in any of our deals. Now, it can be a huge factor just because they recognize the potential risk of it, and there are companies that have managed that risk quite well, such that it doesn't have an impact on the merger or the acquisition. But the more often than not, there's risk. Some level of risk exists, and it's because these companies are focused on growing a business. They're focused on product development, market development. Sales tax is just so far back on the back burner during the sort of build out of a business that it really doesn't come to light until there's due diligence and there's a spotlight put on it. The good thing about due diligence is it's not the jurisdiction's spotlight, and so therefore it's not a bill necessarily that's being introduced, but because the buyer has no interest in taking on any of your risk when you sell, particularly sales tax risk, they're going to force you to either mitigate that risk or they're just going to reduce the sales price. And we have seen example after example of where millions of dollars are set aside in escrow. And either we go down a path of doing voluntary disclosures and getting compliant with states, or the buyers just simply say, look, that's just going to reduce the overall sales price. And it's a factor we're going to have to live with the risk or mitigate the risk ourselves. So you do want, again, if you're going down that path, you do want to start to think about that. And you have an opportunity to mitigate that in a relatively short period of time. There are options. Depending on your circumstances, that option might be simply getting registered today and starting to comply. You're not necessarily looking to sell within the next 3 years. So if you get registered today, and of course I don't recommend registration unless you have both Nexus and taxable products and it's material to you, but get registered today, allow that statute of limitations to start running in your favor. And then 3 years from now, when the due diligence occurs, their question is going to be, where are you registered? What's your filing frequency? Let us see how you're calculating tax. Do you have a process in place? And if you've got those boxes checked, it's going to be a relatively easy environment to navigate. So I think, just to kind of summarize where we have been throughout this conversation is pay attention to your ship-to locations if you're selling tangible personal property. Pay attention to where your customer is receiving the benefit of your service if you're a services organization. One of the complexities we didn't really get into today was there are certainly scenarios where companies are selling subscriptions to SaaS products, software as a service products. There's a bill to address on the invoice, and they may be selling 1,000 seats. Those 1,000 seats may be leveraged or utilized throughout the country, maybe even internationally. And so there's a potential that a good number of those seats are in states that do not tax software as a service. So if the bill to address is to a taxable state or a state that taxes SaaS, it's likely that that vendor is going to charge tax on the entire amount. You as the customer may have an opportunity to mitigate some of that tax based on where your usage occurs. The flip side to that equation is if you are the vendor that's engaged in those kind of activities, you kind of don't want to know where all those seats are being used, because to the degree you do have that knowledge, you start to become obligated to bifurcate your invoice for sales tax purposes, and you could end up with 15 different sales taxes on the same single invoice. So there's some headaches, but potential opportunities in the same bucket. It's true today, it'll be true tomorrow. There is complexity and ambiguity across the states, particularly when you start talking about services. I think we find my biggest challenge is not so much in determining the taxability of a service or a product, but defining what that product or service is. And there can be services and products that one state determines it's one type of service and another state determines it's a different type of service. So I could have a service that's exempt as a professional service in one state and taxable in New York because New York considers it a security service, and security services are taxable. So there's just a variety of scenarios that can exist. Doesn't exist in every business, but some businesses do have some of those challenges, particularly when you get into bundles. And lastly, your obligation to your business, to your customer base, to your employees, you don't want to be in a position where you have an undue risk or an undue exposure. Whether it's funding that you're trying to achieve, whether it's selling the business, or it's simply the potential that you're audited and assessed. Those assessments can sometimes be very surprising and very impactful to the business operations and cash flow of the business. So something to consider. Our philosophy, just to kind of final comment here, is this is all about managing risk. And when you talk about managing risk, there are variables such as materiality that have to be taken into consideration. There's a cost to compliance. We all recognize that. And where that cost is more than the risk, take liberties with that. Don't necessarily go headstrong into being compliant everywhere when it doesn't make sense. But make sure you understand all the variables as well. And at some point, there's going to be a flip. The risk is going to outweigh the cost. And the other thing to consider is once you start a compliance process, adding additional states to that process shouldn't be that challenging or costly. So an incremental add to go from 3 to 5 states shouldn't be a big deal. Going from 0 to 3 could be a huge deal for you. Just answering those questions, do I have Nexus and are my products and services taxable, is really where everybody's going to have significant challenges. So thank you, everyone.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.